Hello, 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 and happy Thursday. Thank you for being back for yet another live event where we unpack deal due diligence and multifamily underwriting one step at a time. Where are all the deals? That's a question I am asking, and a lot of investors are asking. So I thought I would do a brief pop up outside of the scheduled LinkedIn Live events to share my thoughts, what I'm seeing, what a lot of my colleagues and partners are seeing, and share with you those collective observations. But before I dive in, for those who may be meeting me for the first time or tuning in for the first time, my name is Vessi Capulyan. I'm a former commercial lender turned real estate investor, and I'm active in the multifamily space today. I help business owners and high achieving professionals, high net worth individuals. I connect them with well vetted cash flowing investments in apartments specifically. And I also help investors and family offices with the due diligence process. And of course, for those willing to do a deeper dive, I have a community that comes with a self paced course and ongoing support. So let's dive in. Where are all the deals? that's that's what a lot of people are asking. And actually, I wanted to read a couple of stats that were shared not too long ago at the beginning of the year. So, 1.8 trillion loans maturing this year and next year, about 30% of which are in multifamily. Approximately 20 billion of multifamily loans with debt service coverage under one time. That's per CRE analyst. And then per TREP, nearly 50% of securitized loans would require an equity injection at refinance if they were to refinance. So you read all the statistics, and this is hard data, right? These are not made up numbers. And at the beginning of the year, a lot of us thought that this is it. That's where a lot of deals will start trading. But unfortunately, I haven't seen that many transactions. And even though deal volume has picked up relative to last year, it's not at the $1.8 trillion level that myself and many others admittedly expected to see. And we're officially already in the third quarter. Now, and there were a lot of deals that were maturing last year that were supposed to expire this year, third and fourth quarter. And typically, as an investor, you're not going to wait till the 11th hour to take action when your credit facility matures. So, by virtue of a lot of these deals maturing third and fourth quarter, I would have expected at least 30 to 90 days. But those will trade most likely 90 days because, again, nobody's going to wait till the 11th hour. And we haven't seen that happen in the first or second quarter of the year, which to me suggests that more likely than not, a lot of lenders, to the extent that's possible, are likely working with their borrowers to do yet another extension and kick forward some of these maturities. Now, of course, this doesn't apply to everyone. There are some deals where the lender is watching the numbers very closely as well, right? So the minute they get close to the note value where the lender can get completely repaid, there's a very strong probability they may choose to exit the deal when the loan matures. So not uncommon at all to be dealing with short-term extensions if they believe they'll hit that break-even point. So all good for the lender, somewhat good for the sponsor, right? Because they will be able to fully repay the loan, but not so great for the passive investors or the preferred equity partners who may be left with a partial or full capital loss, depending on the circumstances of each deal. And in fact, I've seen some of those where, as I do deal reviews, second set of eyes, and often either co-GPs or capital allocators would reach out to me, or passive investors who need that help with the second set of eyes. And not too long ago, there was a deal where the sponsor's fighting really hard, okay, and it's hard for everyone, both the LPs and the GPs. They're trying to save the deal, and ultimately they looked at the numbers and realized, hey, it's better if we exit now, because if we wait any longer, at least if we exit now, we have the opportunity or the probability of returning 50% of the capital to investors. If we wait any longer, that number can dwindle potentially to zero. So there are a lot of these decisions that are also going through, because the reality that a lot of these owners are facing, the ones that have to sell or whose credit maturities are coming to maturity, is, do we sell? And depending on market, asset class, but you're looking at, in best case scenario, at 5.5 cap rate, in most cases 6, and if it's a class C property in the tertiary market, you could be even looking at 7% caps. And even if you assumed cap rate expansion in your underwrite, say if you bought the deal at 5 and maybe you assume 5.5 at exit, saying that last example I gave, class C property in tertiary market, you could not have forecasted it's going to go to 7. And in prior lives and some of my content, I've shared why that is, but the biggest driver is the demand and supply, the macroeconomic environment, which is compressing rents, elevating expenses, and then of course the rapid and enormous increase in interest rates, all of which have resulted in compression of cash flow and therefore compression of valuation. So nobody could have, I think, forecasted the magnitude of the cap rate expansion. So even if you underwrote the deal conservatively with a maybe 50 to 100 basis point increase in cap rate, going from maybe 5 to 5.5 or 5 to 6, you couldn't have predicted it's going to go to 7, right? So a lot of owners are now facing this situation. Well, if we were to sell, have to sell at least at a 6 or 7 cap, and I definitely won't be able to realize the returns, but I hope to at least return the principal to my investors. That's step number one, protect the downside. If they want to refinance, well, then they have to, more likely than not, bring capital to the table. And that could come from a number of different sources, whether it's their own pocket. And a lot of cases we've seen already multiple capital calls happening to enable that refinance into permanent debt. And sometimes they're bringing in third parties, like preferred equity partners, that may be able to provide that extra sludge of capital to help with the refinance. If their view is, hey, if we hold it for a couple more years, maybe we can not only protect the downside, but maybe even make a small profit, but at a minimum protect the downside and protect the capital. So a very difficult decision to face. And so, and the ones that are selling, at least on the deals that I'm seeing, there's still a pretty good amount of price discovery that is happening in the market, because as a seller, it's not easy to face the reality. Hey, I thought I'll be selling this at a maybe 5.5 cap, and now I have to sell it at 6.5, 7, right? So a lot of them are holding firm to the extent they can. Not everyone can, but to the extent they can, they are. And then on the buyer side, some of the deals that I've seen trade, and when I say I should probably clarify, because I'm personally not necessarily searching for deals. Usually sponsors come to me for strategic guidance and or capital support. So that's where typically I would come in. But in conversations with them, as well as what they're seeing in the market, is in many cases, many of them haven't traded for a while, right? So there may be people out there who are eager to trade. And so when the negotiations with the seller start happening, they're bending the risk spectrum a little bit, and maybe overpaying for the deal with the hope that the market will improve, cap rates will compress, and then they'll still be able to achieve decent returns, 15 plus or minus IRR over the 5-year hold period, which to me is risky because we don't know where rates would be. And if you're reading any of the news, and inflation has been sticky, and with the tariffs that may actually increase further, who knows? The Fed is definitely in a very difficult predicament to manage that soft landing, and that's a whole separate conversation and topic for another live event. But yeah, I do think for people entering the space now and for buyers, still a great time to buy. Probably 12 over the next 12 to 24 months would be great time to enter the market for apartments and multifamily in particular, but not at all costs. So I'd rather pass on an average or marginal deal versus get a deal just because I have capital to deploy. So it's definitely the time to be cautious, excitedly cautious, right? Or cautiously excited, maybe is a better way to put it, because it's a unique opportunity to buy deals at a more reasonable valuations relative to where they were 2 3 years ago, but it doesn't absolve us as investors or the sponsors finding those unique deals from following underwriting and investing fundamentals so they don't enter into these deals at all costs. So um, the key is to stay active in the market, and active doesn't always mean buying deals. It's watching the activity, evaluating opportunities. Maybe you pass on a lot of those, but it allows you to keep a pulse on the market. So I still believe in multifamily, although it looks like that again the momentum that we thought at the beginning of the year will face has considerably slowed down, and of course there are a lot of events that are contributing to that. And now is definitely a great time to be, yeah, cautiously optimistic but also selective, right? Because there were even deals that I looked at that were great sponsor, great market, but when you underwrite the deal, it comes to around maybe 10 IRR. So you could be in a safe investment, but then the question as an investor you should ask, well, is my money invested elsewhere, better invested elsewhere, if I'm looking at a 10% IRR opportunity for investment that's relatively illiquid, right? So obviously that response and answer would be different for everyone. I know what the answer would be for me, which is why I'm remaining cautiously optimistic, continuing to evaluate opportunities, but not jumping in at all cost. And yes, I do think the can has been kicked down the road officially this year, since we're almost into fourth quarter, which means there will be more to follow for the next 12 to 15 months. So appreciate you guys tuning in today, and I pop in live on LinkedIn and I stream it on YouTube as well. So if you're finding value in the content, I'll definitely appreciate you subscribing to my YouTube channel, and I'll put the link in the comments below, or you can follow me on LinkedIn as well, so you can get notified of future live events where I share deal reviews, my experience on the market, share my process for evaluating underwriting deals, sponsors, and the market. And I'm working on something very, very exciting that I'll be sharing soon that will further help investors become educated and empowered. So stay tuned and follow me for more.